Welcome all. I'm Venetia. I'm your host, and here at Canadian SME Small Business Summit 2023, it's a privilege to have you all here. So today we gather here to learn and celebrate our entrepreneurship and thrive together. Our workshop provide expert insights to empower you in the realm of small and medium-sized enterprises. Join us for discovery, collaboration, and inspiration. So let's get an introduction of what is small business worth and how do I use accounting maximize the value. This is going to be by Daryl Ching, CFA Managing Partner at Vista Capital Advisory. So please help me welcome Daryl.
So my background is actually in investment banking, and I started my career at RBC Capital Markets. So when I started my business, I actually started the business doing capital raising, helping companies with their investor presentation, business plan, 3 to 5 year financial model. And we were very successful in securing term sheets. And it was, to my horror, this is where I discovered the importance of accounting, was we had several deals fall apart and fall through the cracks because the financial statements were a mess during the due diligence process. That's when I realized that for a lot of small businesses, the way that a lot of them are set up, they've got a bookkeeper and they've got an accountant that shows up once a year to do taxes. Does that sound familiar to anybody here in the room? So what that means is nobody's asking any critical questions on your financial statements. And so you have a false sense of security because you got an accountant, but you get a rude awakening when you actually approach an investor and actually have to go through that process. I just want to get a show of hands. How many people in the room are business owners and own businesses? Perfect. And how many people have gone through the capital raise process or are going through the capital raise process? Okay, so and some who's thinking about it? So a number of you are probably thinking about it. So I'm going to quickly flip through here, and I was going to do another set of questions, but I'm going to skip it. And basically, the question was, how important is accounting in terms of an investment for your business at an early stage? I will just give you the answer. Generally, it's not. And most businesses prefer to put money into sales and marketing and operations and technology before they put into accounting. And the CFO is typically the last executive position that gets hired in any business. But what I'm here to tell you is what happens when you neglect accounting too much. And really, is this presentation going to scare you? Probably. And it probably should. So, for a lot of people, when they first start a business, seed money is the first round that they do. Could be a Kickstarter campaign, could be going to friends and family. And the evaluation is really, really subjective at that point. A lot of people are at an idea phase. And so it's trust in the entrepreneur is the biggest factor. So we're going to skip that, and I'm going to go to Series A. Series A is when you are raising capital, you have already established proof of concept, meaning that you probably generated some revenue, probably under $2 million, but you're not profitable yet. And you have a full product and you're ready to commercialize. It's the general stage of Series A equity financing. And that's where I'm going to focus. And how do you get a valuation for a company that's not profitable? You can't take a multiple of EBITDA like you can for a larger business that's mature because you don't have profit yet. So it's a very, very, very subjective point of valuation. It's more of an art more than a science. The two key questions really are, how good is your story and how well do you tell it? Would you be surprised if I told you that a CEO that presents confidently could add $1 million to the valuation just because they presented their business plan really well? That is the reality. So, it is very, very subjective. But there are some key factors that come into play when they're looking at a small business. The strength of the management team is typically the most important factor. Does the management team cover all facets of the business, launching a brand from scratch? Barriers to entry, competition analysis, the size of the market are other factors. We're going to go and touch on some of these, but I am going to focus on finance and accounting because that's what I know best. So when you go through that stage of actually closing capital, getting term sheets, the first document that anybody requests are your financial statements. And I want to make sure that we avoid this pitfall. Please listen carefully as a cautionary tale before you send your financial statement to anybody, whether it's a bank or to an investor. But based on what I said, if you have a bookkeeper and you have an accountant shows up once a year, you're probably not doing your financial statements properly for investors. it's probably being done just good enough for tax purposes. So when you submit a financial statement that is poor quality, what impression do you immediately give to an investor? Well, you're a company that may have risk of overspending. You might run into cash flow issues because you don't take accounting seriously. And if your accounting is messy, you're going to have trouble obtaining bank financing and debt financing in the future. So here are some pitfalls to avoid, and these are actual things that have caused deals to collapse. So I'm giving you real things that have happened in my experience in the capital raising process. Poor understanding of gross profit margin by product and service. So I think a lot of CEOs know their top line revenue and they know their profit, but they don't know very much in between. And the in between are the details that you really need to know. So from the perspective of, do I know my exact gross profit margin, my revenue minus my variable expenses on every product, every service I offer? Without knowing that, there is no way for you to know how much your business can scale. And that is a very important question, because as part of valuation, it's how fast can you scale your business. Poor understanding of fixed expenses. The most typical thing that I see is a too broad of categorization on your fixed expenses. So you might have $1 million of expenses, and it's $250 in G&A, $250 in sales and marketing, $250 in administration. But do you truly know? Oh, someone really wants to get into this presentation. So do you really know what your expenses are? And sometimes when we actually do a deep dive and we look into the financial statements, you'll go into the general administrative expenses and you'll see, oh, there's SEO in here, there's marketing, and there's very little thought put into the categorization. Well, what does that tell an investor? It shows that you don't really watch your expenses. And one of the key components of running a successful business is ensuring that you always run lean and you know your expenses really well, categorize well, so you know exactly where you can cut. So that's really important. And then there's a term here called operational leverage. One of the things I will ask you as a business owner, in order to double your revenue, how much do you have to increase your fixed expenses? And if that's an answer you don't know, it's something you should definitely look into and be prepared to answer. Poor understanding of capital expenditures. Here's what we typically see. A lot of times investors will do a presentation and they'll say, okay, we're going to bring manufacturing in-house in year 3. Then I flip to your financial model, I look for CapEx and I see 0. And so your financial model that you built does not match your story in the investor presentation. Very, very typical. If you're going into a sophisticated institutional investor, that will jump out right away. That's something that you definitely want to avoid. And if you're going to be doing something like bringing manufacturing in-house, expanding to Europe, you have to have looked into the costs. Where are there compliance costs? Are there capital expenditure costs? Have you gotten quotes to determine how much of these costs will be? Inaccurate shareholder loans, a very common one. A lot of small business owners are using how many people use their personal credit cards and personal bank account to buy things for your business? So that's happening a lot right now. You need to be tracking every one of those expenses and booking as a shareholder loan. If you don't say anything, I guarantee your bookkeeper is not looking into that. So what's going to happen is you're going to say, well, the company owes me $200,000, so I put in $200,000, and you flip to your balance sheet and it shows 50K. And then so the investor goes, okay, so you're owed 50K. No, I'm owed 200. Well, your balance sheet says 50K. And they have to go back and look for the other $150,000 of expenses. And it becomes a cleanup and a mess. Avoid that at all costs. How much the shareholder is owed is a really important component of the balance sheet. And then long-dated AR/AP. So this is the other thing that I ask every business owner to do. Before you show your financial statements to anybody, pull up your AR aging report, which shows your accounts receivable by age. What is the oldest receivable in your books? And often the answer will be something over 5 years old that doesn't exist anymore. It is very common for people to have legacy receivables and payables that are not real. Therefore, you inflate your receivables and your payables on your balance sheet. An investor sees that, game over, because your financial statements are no longer reliable. So it's something that you should definitely check. And the convoluted share equity structure. The shareholder equity should be easy to understand when you're presenting. So now I'm going to jump to the importance of the financial projections when you are doing an investor presentation and you're pitching investors. So just do your projections match your story? Is the biggest issue, right? If you're going to put into a presentation milestones of expansion, about things like that, it has to be in your financial model and you have to have costed it out. So Now, before I get deep into these components, when I go and I watch investor presentations at an angel forum or a venture capital forum, the financial projections is usually the worst part of every presentation. Business owners are great at talking about their vision, about their sales strategy, about their product. But when it comes to financial projections, they show a hockey stick revenue graph and they go, okay, good, any questions? Great, let's move along. And that's typically what happens. But here's what I would say. Having solid financial projections is not going to guarantee you an investment, but not having them could be the reason why you don't get your funding. And if you have solid financial projections that you are able to explain, you put yourself ahead of the crowd. You stand out as somebody who has done a great job on something that nobody else has done a good job on. So here are some tips when it comes to financial projections. Justification for your revenue. When you have a hockey stick revenue graph, it's okay to have a hockey stick revenue graph, but if somebody says justify it, you need to be able to. How did you double your revenue from year 1 to year 2? Well, we've already started a digital marketing campaign. We've already got this data for cost acquisition. We think it's going to improve 15%. If I deploy another $50,000 toward my marketing budget, then I can see me doubling my revenue. You have an explanation. That's all that matters. Does it have to come true? No, it doesn't. And people are like, well, why is this important? Because I'm not going to be able to predict the future anyways. And you're absolutely right. Whatever you put on paper on your financial projections is likely to be wrong. But what it shows is how much have you thought into the future? Or are you only looking at this year? That's what you're communicating to investor with your financial projections. So justification for your revenue. Your ability to improve gross profit margins. An obvious question, especially if you're selling products, is, well, when you scale and you start buying more, how much does your variable cost come down? If you haven't had that discussion with your manufacturer, then that's a weakness. And a deep understanding of operational leverage. An example of, can you double your revenue but only increase your fixed cost by 20%? That's a good story to be able to explain that through operational leverage. For a balance sheet, I've touched on a lot of these things in my previous slide, but you definitely want to make sure you're capitalizing your R&D. So in a lot of presentations, people say, I've invested $100,000 in R&D. Well, you got to make sure you've got $100,000 capitalized on your balance sheet, and it's not showing up as an expense item causing a huge loss in your profit and loss statement. Efficient use of leverage for financing operations. A lot of times one of the things I look for when I look at the presentation is to what extent does a company layer on debt financing, because of the understanding that when I raise equity, I can actually get bank financing and debt financing in the future. If I see debt financing, I see that an understanding that you have other levers you can pull for the capital raising process. And then the other thing is cash flow. It often does not exist. A lot of companies present and don't even show a cash flow. So they only show the profit and loss, which is not a cash flow statement. And when I don't see a cash flow, the obvious question is, well, how do you know you're asking for enough money? And with that money that you're asking for, is it enough to fulfill your business plan? If the answer is no, that's okay. You could be in a position where you say, I've raised enough capital to get to a certain milestone that I'm ready to commercialize, but in 18 months, I'll have to go back to market and raise another $10 million for my Series B. If you say that, that's okay, but you have to say it. And you have to demonstrate that you understand that, right? Rather than just being deer in the headlights if somebody says, well, how do you know that's enough cash? You have to have an answer. If you are able to do these things, I guarantee you that you will stand out in the crowd in a presentation. So let's go really quickly into some of the other factors. In my opinion, strength of the management team is actually something that is that is kind of ignored in a lot of presentations. I see presentations where they have just, the few pictures and the names and a really brief bio. In my opinion, there needs to be a lot of emphasis put on the strength of the management team, because at the end of the day, it's how good are the people that are going to execute this business plan. And you want to have all facets covered. So if you are selling a product, you want to show that somebody knows how to grow a business, somebody knows how to source product, somebody knows manufacturing, somebody knows branding. And if any of those components are missing in the key management team, then you want a plan to address that. Well, that's okay. I'll go to a marketing agency that has a very good reputation and is solid in this industry. But they want to see that you've thought out every component of the business and you have each facet of the business covered. And that's really the most important part of the management team. The other quick thing I'll say too is you want people that have created brands from scratch and have done small businesses. I see pitch decks where people hire the VP of Google for marketing. That may fool a retail investor, but an institutional investor will see right through that, because a Google executive probably walked into a company that already had a brand, probably had a $100 million budget, and had people to delegate work to. That's not the type of person that you want running your brand. You want somebody who has grown a brand from scratch. So it's really important to have the right people in the right seats in the management team. Proof of concept, I do want to talk a little bit about what proof of concept is not. Proof of concept really, in my opinion, is revenue selling at your market price. So if you're selling at a discount because you're beta testing, that is partial proof of concept. I don't think that's full proof of concept. If you sold 10,000 units through a Kickstarter campaign, that's not really proof of concept, because it's a forum where entrepreneurs support entrepreneurs. And so the best thing you can do is have real sales as much as possible at your market price where you plan to sell your products and services. That is real proof of concept. Anything short of that is partial proof of concept, and it's going to hurt your valuation. But there are obviously things you can do to try to validate your concept to get to proof of concept, including like surveys as an example of doing a survey. Would you pay for this product? Is this a real pain point? How much would you pay? The go-to-market strategy is a far more important piece now than it ever was before. And the reason was because in the past, 20 years ago, I could be a marketing manager and I could just put an ad in the newspaper, radio, or TV, and I'll get 3 million eyeballs. And it was actually quite simple. I think marketing is so hard today because there's so many different mediums that are competing for eyeballs. And I mean, it could be a lot more efficient, the digital marketing, but if you've got somebody who does not know what they're doing, you could be throwing a lot of money down the drain, and you could be not getting the audience that you want. In my opinion, if you're a company that has a mediocre product, but you have a brilliant branding strategy, I would bet on you more than I would bet on a company that has the best product in the world, but no branding strategy. That's how important branding is, because people buy brands. People are loyal to brands. They don't buy products today. So this is a very, very important component in the pitch deck today. The size of the market, well, the comment I'll make about that is I would advise against going after an $80 billion market and overgeneralizing your market. So the example I use is if you've got a hair curler, electronic product for hair, well, your market is not the entire hair market. Like hair market includes shampoo, conditioner, and consumables. You want to zero in specifically on the niche that you're after, and what you want to nail. If you want a home run on the size of the market, you want an underserved niche where there is not that much competition. You identify that small niche, even if it's only a $50 million niche in the global marketplace, but you could figure out how to get 50% of it. That is more convincing, and that could be better than going after an $80 billion market where you say, well, the world's my oyster. Competitive landscape. So when people present competitors, a lot of them list their competitors and they stop there. I want to see you actually list your competitors, list their strengths and weaknesses, and tell me how you plan to beat your competitors. So, you know, the brief comment here is often I don't see enough information on competition. This is really, really important on your strategy on whether you beat them through pricing, whether you beat them through a different value proposition that's different from what's being offered in the marketplace. When it comes to barriers to entry, the best thing you could do, the best story, is to have a higher barrier to entry, but you've already beat it. And I will give the extreme example of cannabis in 2018 when they gave out 100 licenses. If you were one of those lucky people that got a license to produce cannabis, you immediately had a $50 million valuation. You didn't even have to have any revenue. So that is an extreme example. Now, if there are low barriers to entry, what you want to push is the fact that there is a huge first-to-market advantage. So because the other copycats will come, and the question will become, well, how do you prevent copycats? How do you beat people to enter the market and copy your product? And so from that perspective, it's first mover advantage, build a loyalty, build a following, and have something sticky, a product that's hard for people to get rid of so that they stay loyal to you. That's kind of the story you want to tell when there's low barriers to entry. But of course, you can address intellectual property and patents. To the extent that you have patents that will prevent copycats, that's a very convincing story as well. And often getting that patent raises your valuation immediately. If you already have it or you've applied for it, it boosts the valuation. Exit strategy. This is not part of valuation, but it's important that it's actually a question that a lot of people don't think of and they get caught off guard, where they're presenting and an investor goes, hey, so what's your exit strategy? And then they get caught off guard. It's good to know what that is because you've got different types of investors. You've got long-term investors that are looking for a long-term investment where they get dividends because it's a strong cash flow business. But you also have investors that want to make a quick exit. They want out in 3 to 5 years. Do you have a 3 to 5 year exit plan? Are you going to IPO? Are you going to get acquired? So having that answer is critical, and I encourage everybody to have that answer. It does not necessarily need to be a slide. It can be, but you need to be able to answer that question on the exit strategy. I got a few points here that I'm going to just speed through, but when the consideration for acquisitions, this is for a company that's completely selling their business, but I always ask the question, what happens if the CEO goes on vacation for a month? Does the company stop operating? Or can it continue to run? That is absolutely crucial because a company that is scalable is one that does not require the founder and CEO to always be present. And a company generally can only grow if a CEO founder is looking at vision and looking at strategy, looking at business development. So to the extent you can empower managers and create processes so that people are able to make day-to-day business decisions and does not rely on the CEO, that is the best thing you can do to scale your business and to make it more valuable. So processes around HR, sales, quality assurance, financial policies. I'm going to jump to nepotism because this is a big one. If you have family in the business, that's not necessarily a bad thing, but they are under more scrutiny by investors. Investors, when they see the last name is the same for a key position, immediately the question becomes, does this person deserve this position? Is this the most qualified person? And there's a little bit of an uphill battle to prove that your family member is the right person to sit in this seat. So you do have to address that and just be weary that immediately that's what someone's thinking as soon as they see that. And finally, remove emotion. So for anybody selling their business, it is possible that whoever acquires you will fire all your favorite people, and you have to be able to live with that. There's no situation where anybody can guarantee that people that have been loyal to you are going to be able to stick around with a new owner. So remove that emotion. If you are really concerned about a particular employee, have them part of the buyout. Say, listen, if I get bought out and you get fired, I'll give you part of my payout. So you can make a different arrangement, but do not have any expectation that you're going to have any control over this business once it gets sold is the key thing. So that's it. I want to stop there and leave some time for questions. So I think I'll open the floor for questions. Yes?
Can you give me an example of what a convoluted structure for shareholders looks like?
Yes. So any shareholder structure that has multi-classes, Class A, Class B, Class C, Class F, Class G. Oh, sorry. The question was an example of a convoluted equity structure. And when there's multiple classes of shares, it just makes the picture a bit more complicated. I'm used to two classes being one being voting and non-voting. So that's okay. But I've seen classes where this person retains IP, classes where this person is number one in the cash waterfall structure in a liquidation. And when it gets too complicated, investors do balk at this.
So what if you have an estate freeze and you have a succession plan which involves different classes? How do you eliminate that so that you can attract investors?
So there is a possibility that there could be a negotiation with your investor to simplify that class. And it could be that some people give up some of their rights. I have found this becomes a hurdle in negotiation because the investor goes, well, where do I fit? How do I squeeze myself into this box? So, and in fact, I've known people that had to give up voting control, that had to change structures, the equity structures, so that it became a little bit easier for the investor. It depends on the investor. Some investors are accommodating, some investors are not. So, but if you bring in a significant shareholder that has over 30%, they're likely going to want control. They're going to want a board seat, and they're not going to want that complication. And they're probably going to ask your investors to give up some of those rights.
Okay, thank you.
Thank you.
I see you have a question there.
With regards to digital, thank you. With regards to digital assets such as a website that has high search engine ranking and a lot of traffic, how would you reflect that on a balance sheet?
The most typical way is cost. Is the easiest way to do it for small private business. So it's how much did you invest in building that website? Unfortunately, like, we don't really do fair market value on websites, and I don't know of a common methodology yet. But for example, if you invested $50,000 into building that website, you can easily capitalize that cost at $50,000. Now, where you can probably make an argument in your favor is on the the useful life of the website. So you can say, I've created a fantastic website that's going to have a 10-year shelf life where I'm not going to be able to need to change it for 10 years. And then you can amortize it over 10 years. So that creates a much larger value because you're depreciating less of that asset from year to year. But from my perspective, we do cost-based accounting when it comes to investment in R&D, investment in websites. When you become a public company, there are other ways of fair market value. But for private businesses, generally, we stick to historical cost.
Thank you.
If I could flip the conversation, I think your presentation has a lot to do with presenting to capital investors, but I think there's a lot of opportunity with retirees that are looking to retire out of their business and potentially sell. And if you're looking to acquire a small business, what are some of the red flags that you think you would look for? Because a lot of the people who are looking to sell their businesses have not covered even a small portion of some of the topics that you went through today. And they may not be able to, in fact, provide that information in the course of, they're looking to sell their business. So my question is, what are some of the things that would really lend to, okay, I see value here, even though, we haven't covered all of the topics that you went through, or some of the red flags, in fact, that, okay, if you can't provide this, then maybe, this is not something that we want to pursue further. Yeah, or the value is just not there.
This is the hardest part about the baby boomers selling their businesses. Unfortunately, a lot of small family businesses have operated with the mentality of, I want to minimize my taxes. And that means piling on expenses to bring my profit down. And it sometimes includes hiring your nephew that works 2 days a week, but you pay them a full-time salary. And there's personal cars in the business. And you drive your profit down to zero. So you have this conversation with the retiree, someone who's looking to retire, and they're like, well, that's not my real profit. My real profit is actually $1 million because I don't have to have my nephew here. I don't have to have the personal cars here. So what ends up happening is you start doing an adjusted EBITDA. You take their financial statement, they file a CRA, and you adjust. And then you get to what they believe is the real valuation. Well, anytime you have that, there's obviously a discrepancy that requires a lot of due diligence. You have to confirm if every adjustment they're saying is actually true. The advice that I have been given, and I've been pulled in to give advice to some of these companies that are planning to sell, is stop this right away. You want to show 3 years of profitability. So take your nephew off the payroll, or pay your nephew 2 days a week if that's the work that your nephew's doing. Take the personal cars off. Get lean. Start cutting expenses. Maximize your profit. Because if you really want to sell at the valuation that you want, you're going to have to prove to an investor that this profit is actually real. And often it's not if you say, well, just trust me. And just trust me doesn't always count. So from your perspective, I would say you're probably going to encounter that where they say, well, this is my real profit. And you're going to say, well, show me. And you're going to argue back and forth, even though their CRA financial statements say something different. That is the hardest part to verify. So my advice to those businesses, cut it out altogether. Stop doing that, right? Like, minimizing taxes is a completely different goal than selling your business. And they have to start that and do that process for 3 to 5 years. Does that answer your question? Okay. That's a big one. And also, most private companies don't have audited financial statements. They have a notice to reader that's prepared by management. So you actually have to go through and question every line in the financial statement. One of the ways you can do that is go through the bank statements. So one quick check, I'll give you one tip, is if they say they have $1 million of revenue, look for $1 million of cash inflows on their bank statements over the course of a year. That's one check. But obviously, that's one of many different checks that you can be doing.
I was actually going to ask a very similar question, but now I'm curious about the room. I know everybody put up their hand and said they're a small business or a small to medium-sized business owner, and it is about these mom and pop shops that I'm most curious about. Is anybody in the room planning to sell their business in the next 5 years? Not here to learn about raising? One person? If the price is right? Okay. Yeah, my question's a little more convoluted at this point, but I'll come up and talk to you after. But I just wanted to see who was trying to sell and who's trying to raise. Buying and selling, excellent.
Yeah, and so my best advice to anybody who's looking to sell, stop thinking about minimizing taxes and start thinking about maximizing profit right away. That's my best advice.
Quick question for you. What kind of EBITDA multiples are you seeing right now of these private businesses selling for?
Depends on the business, but the most typical multiples for small private business is about 4 to 6 times. Is the most typical.
I just wanted to know the process for getting in investors in form of equity. Like, let's say if I want to offer stocks to employees or new investors or partners, how do you go about as a small business?
So as a small private business, obviously equity has a little bit less cachet than it does if you're a public company, because the employees are aware that they're not going to be able to cash out right away. Having said that, there is a possibility to do it. Often the way that I structure equity, help companies structure equity, my advice, only for key executive positions. I wouldn't do it for staff. I find that staff are not that motivated by equity. If your point is to drive a behavior and drive better performance, equity doesn't do it for staff, for junior staff, because they start to realize they don't have that much of an influence on profit, which is really what equity is. So if you decide for an executive business, I want to bring in a CFO, I don't want to pay $250,000. I want to pay 100 and give 100 of equity. Often what I do is I go, okay, I'm going to bring in somebody at a certain market salary. So the market salary is 100. I only want to pay 60, so there's a 40 delta. I'll compensate you 40, maybe more, $50,000 in equity is the mindset that I have on how to get someone on board and onboard somebody at a lower salary. So that is often the most used technique. Usually it's common shares, and if you can convince them to take non-voting, that is ideal. You want to retain voting as much as possible. As soon as you give up 66 2/3 voting control of your business, you start to lose certain parameters and controls. So you want to make sure you retain voting as much as possible.
And from an administrative perspective, what are the steps to follow to do?
Well, it would be with a lawyer, right? So a lawyer would assign a certain number of common shares. So you would say, I want to assign this person 5%. Now, a lawyer would structure it so that they have 5% common shares. My advice is consider options as one, saying, okay, I'm not going to give you straight equity, but I'll give you the ability to purchase shares at a set price in the future is another option you can have, and to vest that stock over a period of time, usually 3 years. So if you're going to give $100,000 of equity, that person has to be working for 3 years for your business and in good standing, investing a chunk every quarter that they're in good standing with your business is the most typical structure. But that's a question for a lawyer. A lawyer would be able to draft the agreements for you to be able to do that.
Thank you.
You're welcome.
So for a hot topic company that is starting, a startup, AI hot topic, what would be a red flag on the valuation for a Series A rounding?
For AI technology, technology is a tough one to gauge because I feel like a lot of them, you're going to shoot for the moon or it's just going to go nowhere. It's almost binary, right? I personally, I'm not a fan of pitches that say, okay, we have no path to revenue. We're just going to grow our user base and revenue will come. And there's no clear path to revenue. There's too many of those presentations. I think people watch Social Network and Facebook and thought, if we build it, it will come. And to me, it's like, no, I mean, now I think you need a strategy that does generate revenue in earlier years, year 2, year 3, year 4, where you structure in some revenue. So the biggest flag for me is one where it's like, I don't have a path for revenue. I just know I'm going to grow my user base to 1 billion users, and then I'm going to exit at a $50 billion valuation, right? And there's too many of those tech pitches where people think that way, like they're the next Facebook. And so that would be the number one thing in my head. But thank you very much, everybody, and thank you for your time.